When was the last time you actually looked at how much interest your savings account is paying you? I don't mean just glancing at the app. Did you actually sit down and do the math? I did this about 6 months ago, and let me tell you, it made me a little sick to my stomach. Why? Because I realized what was happening. Here's what was happening. I had $12,000 sitting in a savings account at one of the big national banks. You know the kind. The ones with billboards everywhere and sponsorship, running ads that say we care about your financial future. At the end of a full year, my interest earnings were $21. Yes, $21 on $12,000 over 12 months. And the part that truly shocked me was that I thought I was doing the right thing. I thought putting money in a savings account was the responsible thing to do. Isn't that what we've been told for years? Don't spend, save, put it in the bank. But while my $12,000 was sitting there earning almost nothing, that same bank was lending my money to other people on credit cards at 20 to 24%, sometimes even 29% interest. So they were making thousands of dollars using my money and then handing me $21 and presenting it as if it were some kind of favor, some kind of gift. My name is Sammy, and I've spent years racking my brain over how money actually works. Now, I share everything I know with you on this channel. Since the day I started researching the savings account system, what I've found has completely changed the way I manage every dollar I earn and the way I look at this whole situation. If you've ever wondered why your money isn't growing, even though you think you're doing everything right, and you keep asking yourself what you're doing wrong, stay with me. Because by the end of this video, you'll understand exactly how and why the system is designed this way, and most importantly, what you actually need to do. If you're ready, let's begin. Before we talk about what's happening, I need to give you a brief historical background, because understanding how we got here will help everything else fall into place. The concept of a savings account actually started out as a pretty good deal. In the 1980s, savings accounts at American banks were regularly paying 8 to 10%, even 12% annual interest. In 1982, if you had $10,000 in the bank, you were earning over $1,000 a year just from interest. Back in those years, the bank was genuinely working for you. So what happened? Why did that go away? There isn't actually a single reason, because several things happened. Interest rates set by the Federal Reserve dropped dramatically over the following decade. Against this, banks found more profitable ways to use your deposits, investment banking, complex financial products, fee income, and so on. At some point, American consumers accepted this situation. They kept opening savings accounts because that's what you were supposed to do. The habit was already ingrained in us. And right at that point, banks realized something. Most people weren't actually shopping for better interest rates, weren't actually doing the math, and weren't questioning why their savings weren't growing. According to the FDIC, as of 2024, the national average interest rate on a standard savings account is just 0.45% annually. Let me put that 0.45 in dollar terms so it really sinks in. You put $10,000 in a standard savings account. At the end of a full year, you earn $45. At the end of 5 years, if the rate stays the same, you will have earned about $227. And in 10 years, about $459. Meanwhile, the rate at which the cost of everything around you is rising, inflation, in short, averaged about 3.4% per year over the past century. And more recently, you've seen it rise dramatically, haven't you? The bitter but true thing nobody tells you is this. When your money is earning 0.4%, while inflation is running at 3.4%, you are not actually saving money. On the contrary, you are losing money. Every year that passes, your $10,000 can buy less at the grocery store, pay less of your rent, cover less of your car repair. On paper, you have the same number, but its real-world value is unfortunately shrinking. Economists call this the real return on your money, what you get when you subtract inflation from your interest rate. And for most standard savings account holders, the real return is deeply negative. So when I said savings account scam, I wasn't exaggerating. It describes exactly the situation we're in, and I'll keep explaining. Leaving history behind, let's get to the core question. When you deposit your money, what does the bank actually do with it? Most people vaguely know that banks lend money, but the truth is far more specific. and far more profitable for them than that vague notion implies. When you deposit $10,000 into a savings account at a big bank, several things happen. First, under a system called fractional reserve banking, the bank is only required to keep a small fraction of your deposit on hand, typically around 10%, though since 2020 the Federal Reserve has reduced the reserve requirement to zero for many institutions. So theoretically, this means the bank can lend out nearly every dollar you give them. Second, the bank pools your money with the deposits of thousands or millions of other customers, creating a massive capital pool. Third, and this is where it really gets interesting, they direct that capital into multiple income streams simultaneously. Consumer loans, credit cards, auto loans, personal loans, these come with interest rates averaging from 20% up to over 30% per year. Then there are mortgages, which have been running between 6% and 8% in recent years. Commercial loans are in the mix too. Businesses borrowing from banks for equipment, real estate operation. And then there's the part that doesn't get talked about much. Banks directly invest in bonds and yield, generating financial instruments. So your money isn't in one place. It's working in 4 different channels simultaneously. For them, of course, not for you. Now let's do some math and look at the staggering numbers together. Let's say your bank collected $1 billion in savings deposits. They pay all these depositors an average of 0.45% interest. That means $4.5 million going out to depositors per year. They lend out $700 million of this across all loan products at a blended interest rate averaging 12%. That's $84 million coming in per year. Subtract what they paid you, and you get $84 million minus $4.5 million, $79.5 million in pure net interest income. On $1 billion in deposits, that's a 7,900% margin on the cost of your money. They're buying your capital for 45 cents per dollar and selling it for $12 per dollar. Right now you might be thinking, banks have costs too, don't they? Branches, employees, technology. But this is also true. Banks are among the most consistently profitable businesses in the world. JP Morgan Chase reported $49.6 billion in net income in 2023. Bank of America earned $26.5 billion. Wells Fargo earned $19.1 billion. These are not struggling businesses barely covering their costs. These are some of the most profitable companies in the history of humanity. And one of the key drivers of those profits is the gap between what they pay you for your deposits and what they charge to lend that same money to others. So no, this isn't a conspiracy theory about fraud. It's just basic arithmetic. And it's designed so that you don't actually sit down and do the math. Alright, let's get to the point that should be bothering you right now. If the math is this clear and obvious, why do tens of millions of smart, educated people still leave their money sitting in low-yield savings accounts? The answer isn't stupidity, it's psychology. Specifically, a combination of 4 powerful psychological forces that banks have figured out extremely well but most consumers aren't aware of. The first is the illusion of safety. This means when you put money in your savings account, it makes you feel safe. The number goes up a little over time and never goes down, so there's no visible risk of loss. And that feeling of security feels incredibly powerful, especially for people who grew up with financial anxiety, who witnessed their parents struggle, or who went through difficult financial periods on their own. Our brains have evolved to prioritize avoiding losses over seeking gains. Psychologists call this loss aversion. Research shows that the pain of losing $100 feels about twice as intense as the joy of gaining $100. That's why, even if a savings account is technically losing value to inflation, the fact that the number never drops still makes us feel good. The second is learned inertia. Most of us were somehow taught, either by our parents, at school, or through our financial culture, to put money in the bank, and we've coded this into our minds. But this alone isn't bad advice. Having accessible liquid savings is genuinely important. The specific advice became frozen in time from when savings accounts were actually paying meaningful interest. The advice has since lost its usefulness, but the habit remained. We don't question it because we never had a reason to. And when a financial behavior becomes a habit, it's largely processed below the level of conscious awareness. So even without making an active choice each month, You just keep doing what you've always done. The third is complexity overwhelm. The alternatives to a traditional savings account: high-yield savings accounts, money market accounts, treasury bills, inflation-indexed bonds, index funds, all require some research, setup, and ongoing management. And for many people, this friction is enough to keep them from doing anything. Financial institutions and banks benefit tremendously from this complexity. An overwhelming array of options, however it may feel, increases the likelihood that people will stick with what's familiar, and that, although it may seem entirely coincidental, turns out to be the option most beneficial to the bank. The fourth is the good enough trap. This is something you see constantly. When a person asks a family member or friend about their savings account, the answer they usually get is, "The interest rate isn't great, but at least it's something." This attitude and mindset is one of the most financially destructive statements out there. Because the idea sounds good until you calculate the actual cost. But as you now understand, that cost is not small. It's large enough to shock you. Now let's talk about what this situation will actually cost you over a lifetime. I want you to genuinely confront these numbers and this uncomfortable reality. In the first scenario, let's say you're a 30-year-old average American. You have $15,000 in a traditional savings account, earning the national average of 0.45% interest. You consistently add $500 a month for the next 35 years until you reach age 65. After 35 years, you'll have approximately $248,000 in this account. Now, I know that might sound like a reasonable number to you until you do the next calculation. In the second scenario, you're at the same starting point, age 30, but you're someone who understands what's happening. You still have $15,000. You're still adding $500 a month for 35 years, but this time, instead of a standard savings account, you put your emergency fund in a high-yield savings account offering 4.5% returns, made accessible through online banking since the rate environment shifted. Everything beyond 3 months' worth of emergency funds. You invest in a basic total market index fund with a conservative average annual return of 8%. So what happens after 35 years? You end up with over $1.1 million. Now let's look at the difference between these two scenarios. Same income, same monthly savings discipline, same starting point, over $850,000 difference. Let me say that again because it really needs to sink in. Same person, same income, same discipline, same 35 years. The only difference is where the money was put, an $850,000. This isn't the difference between being rich and being poor. This is the difference between working until 65 and having the option to retire at 55. The difference between leaving your children something meaningful versus every generation starting over from scratch. It's even the difference between being in financial anxiety in your 60s and having real freedom. And yes, unfortunately, most people choose the worse option. Not because they're financially irresponsible, but because nobody ever sat down and showed them this math and explained it this way. I'll tell you something else that will surprise you. You might be thinking, okay, but the stock market is risky and I could lose money. And you're right, in the short term, markets go up and down. But here's what most people don't understand about risk and time. In any 20-year period, in the history of the S&P 500, the market has never closed lower than it started. During the Great Depression, during the 2008 financial crisis, during the dot-com crash, pick any 22-year window in the past century, and assuming you held a diversified portfolio throughout, you made money. Over 35 years, market risk is not zero, but it's far lower than most people believe. It needs to be compared to the certain and very guaranteed loss you experience every year while your money sits in a low-yield account losing ground to inflation. And this is the point where we've completed the framework. I'm not here telling you to abandon all savings accounts and put everything into crypto, individual stocks, or whatever financial influencers are pumping this week. The opposite. What I'm saying is this: between money sitting at 0.45% and money in risky speculative investments, there is a whole spectrum of better options. And most people have never been introduced to the middle of that spectrum. Think of this as three different categories of money because treating them all the same is one of the biggest mistakes. The first category is money you might need within 24 hours. We call this an emergency fund. This money has to be safe and liquid. Okay, but that doesn't mean it needs to sit at near nil interest. Online banks like Marcus, Ally, and SoFi have consistently offered between 4% and 5% interest in recent years. That's 10 times what traditional big banks offer. Same FDIC insurance, same access, word for word, the same security. There's genuinely no legitimate reason to keep your emergency fund in a standard account. The second category involves money you plan to use within 1 to 5 years. A house down payment, starting a business, a major goal. Here, Treasury bills have recently been yielding between 4.5% and 5.5% with zero credit risk. Inflation-indexed bonds are also a strong option for this category. CDs for online banks are coming in between 4% and 5.5%. And the third category, this is the real heart of it. Money you won't touch for 5 years or more. Keeping this money in a savings account isn't conservative. It is financially devastating. Broad market index funds like Vanguard's VTI or Fidelity's FSCAX give you ownership in thousands of American companies. Annual expense ratio under 0.05%. Historical average annual nominal return of around 10%. Real return after inflation around 7%. There's one more thing I want you to notice and understand. Everything we've discussed here is completely legal. Banks aren't doing anything illegal, but they are running a highly rational business that profits from consumer inertia, lack of financial literacy, and the power of default options. Through this video, you've learned how the game works, and now you can play this game differently. Think of it this way. In the simplest terms, banks borrow your money cheaply and lend it back to you expensively. The margin between those two rates is where their profit lies. Now, as someone who understands the system, your job is to shrink that margin as much as possible. And you'll do this as the person who shops for the highest savings rates. Also as the person who never carries a credit card balance. And as the person who directs long-term money toward investment, rather than letting banks use it for free. You'll be the person who takes full advantage of tax-advantaged accounts before the bank takes its cut. Each of these decisions is essentially charging the bank for access to your capital. You're becoming the lender instead of the borrower. And here's the most beautiful irony. When you make these moves, banks won't be happy about it. The bank's most profitable customer is the one with a large deposit earning 0.4% interest and carrying a big credit card balance at 24% interest, while the customer who earns the bank the least is the one shopping for high yields, paying their balance in full every month, and investing the rest in index funds. Be the customer they hate, because the customer they hate is the one building real wealth. So what would I do if I were Sammy starting from scratch today? I can tell you exactly this. Without delay, without telling myself I'll open it someday, I would open a high-yield savings account this week. It's online, and it takes just 10 minutes. I would transfer my emergency fund there and start earning 10 times what I was earning with zero additional risk. Then I would calculate my actual emergency fund number. For most people, 3 months of essential expenses is sufficient. If you're self-employed or in a volatile industry, 6 months. Every dollar above that number should not be in a savings account, because it needs to work harder. If your employer offers a 401k match and you're not contributing enough to get the full match, fix that today. There is no other place in investing with a guaranteed 100% return. If you're eligible, open a Roth IRA, contribute up to the annual limit, put it in a total market index fund and let it go. You only need to check it once a year. The rest is compound interest doing its work. And finally, every time you get a raise or bonus, redirect that money to these accounts before lifestyle inflation swallows it up. The most powerful financial habit in the world isn't cutting your coffee budget. It's systematizing wealth building before you ever see the money. I want to finish with complete sincerity. The reason the savings account scam has worked for so long is not that people are stupid. It's because the system was designed by very smart people with very large marketing budgets to make it feel safe, familiar, and responsible. And for years, it actually was responsible, back when savings accounts paid meaningful interest. But we live in a different world now. And just as interest rates have changed, so have the options. The information needed to make better decisions is more accessible than it has ever been in history. For most people, the only barrier between themselves and dramatically better financial outcomes is not income, luck, or access to secret opportunities. It's simply knowledge. Now you have that knowledge too. Your $10,000 can earn $450 a year, or it can earn $4,500 a year, or it can compound to over $1 million over a lifetime of investing. The number of dollars going in is the same. What changes is whether or not you understand what you're doing and why. Banks have been profiting from your inertia for years. Starting right now, if you think it's time for that to end, you can open an account, make the transfer, automate the contribution, and do it this week. Because the best time to make this move was 10 years ago. But don't worry, you're not too late, because the second best time is right now. See you in the next video.